Is it time to make sure that not all of your wealth building eggs are in one basket? What's up, blue collar business owner? Welcome back to the Blue Collar Prosperity Podcast. I'm your host, Paul Maskill, where we focus on helping guide you to have a prosperous business. Today, we have with us Spencer Ogden. He is vice president of Dock Street, where he works with home service business owners to build their second engine of growth. Founded by Spencer's father, Dan, the firm's investment approach is guided by Dan's entrepreneurial experience, including chimney sweeping and commercial real estate, to guide its investment process. So that is Spencer Ogden. Welcome, Spencer. Thank you so much for being on the show today. What is happening in your world?
Thanks, Paul. Thanks for having me here. Glad to be on today.
Yeah, I'm excited about this. As I said at the very beginning, I feel most of our listeners, home service business owners, a lot of times we put investing on the back burner and say, I'm just going to build, especially in the last 4 or 5 years with private equity buying up all these businesses. Now I feel like a lot of the wealth building strategy is just go all in on this business and hopefully we sell it someday and we ignore all the other opportunities out there. So
definitely building for an exit.
For sure. It's definitely going to be a good conversation. So before we jump into your area of expertise, give our listeners just a little bit of backstory on you, how you got started, how did we get to where we are today?
Yeah, so that story really goes back to my father, Dan, who's still involved in the business. So we get to work together every day, which is great. And he started out on the assembly lines out in Detroit, and that taught him pretty quickly that he wasn't going to be a good employee. So he kind of went on an entrepreneurial journey through a lot of his life. And that included the chimney sweeping business, which was in the late 70s when there was the energy crisis, and they sold franchises all around the country. A company called August West that they ended up cleaning my chimney in 2017. So still existed. That sort of was the first big success, but then I grew up with him going through a variety of businesses: the chimney sweeping business, commercial real estate, commodities trading, a mailbox business that was similar to chimney sweeping, but not quite as successful, but always on the search for what's the right business model, what's the great success. That led to one of his partners in the real estate business gave him a copy of Buffett's letters. These were the partnership letters. So even pre-Berkshire, he used to write 2 letters a year. I still have a copy of those in the vault here. And those really opened his eyes to the fact that big public companies could be thought of as the same way as the small businesses that he was operating, and that there was a crossover here. And we've really come to embrace that in the history of our firm and our investment process, what we call the operator's mindset. What you learn being an operator of a business that you can take into investing, and that you really should think of a business that you're investing in the same way as a business that you run. So that's kind of the genesis of the company, but also the philosophy.
Yeah, it's interesting you mentioned that, because I feel if we treated our business similar to a business that we want to invest in, a lot of times we wouldn't invest in our own business because of the profitability, because of the cash flow, because of all these things that are going on. But yet when we want to go buy, call it stocks or even businesses, we're looking for things that actually make money. So let's dive into that. So you focus on helping specifically home service business owners, really kind of look at the bigger picture and help them really grow, scale, build wealth, and all those things. So let's start at the top with what you mentioned. Why is investing in public companies, say you want to go buy stock in Amazon, why is it, really similar to actually understanding how a small business is operated on a daily basis?
Yeah, great question. I mean, it comes back to some of the words that you just mentioned. Profitability, cash flow is the big one. One thing my dad always says is you don't know risk until you've made payroll. And like the business operator who is worried about payroll every 2 weeks, that's real tangible risk. That's not a ticker going up and down on your screen. Not being able to take care of the people who are depending on you, that's a real level of responsibility and risk. And that really puts the highlight on cash flow, which we think is really a key component to where people get lost in public companies. You said you wouldn't invest sometimes in your own company. That's because the profitability numbers, the cash flow, what discretionary free cash flow you have at the end of each quarter to reinvest in the business. Then when people hop over into public companies, the conversation becomes about the market and interest rates and consumer sentiment and meme stocks. And, people will spend hours researching a new TV. And then the second a buddy says, hey, you should check out, this ticker, they're in, that's all the research they need. Right. So people tend to forget all of the stuff that they know about operating a business. And the numbers are much bigger on the financial statements of a public company. But if you just divide everything by 100,000 or so, you get into numbers that are all the same, and it really comes down to those metrics of margins, free cash flow, and what you're reinvesting in the business. All the ingredients to growth that I think are applicable to both small businesses and public.
Perfect. It's funny you mentioned that because even a lot of times, and for our listeners out there, if you've never looked at financial statements of public companies, you don't ever have to if you don't want to. But it's funny, they already automatically usually do that divide by 100,000. They'll show like
Right.
this is actually hundreds of thousands, right? It might show that they made $1 billion, but they're not going to show you $1 billion. They're going to divide everything by 100,000 to make it really digestible.
Yep. Yep.
So I think that's a good thing to look at because I know many business owners, they don't actually ever, maybe one thing they look at in their entire financial statement is the bottom line of their P&L. Did I make money or did I
Mhm.
lose money? But
Mhm.
that's like a fraction of the entire story. What are some of the things, whether it's those ingredients you mentioned, or what are some of the things
Yeah.
that our listeners should be paying attention to on the financial statements of either their business or when they're looking to buy stock in other companies?
Yeah. So when we're looking at an investment, and I do think this applies to businesses of all sizes, we're looking at 4 things that we call the ingredients to growth. Because one thing we've learned over the years is that growth is the most important thing. And that is what you're essentially always looking for in investment is future growth. The trouble is that if you look for past growth as an indicator of future growth, you're often led astray. There's the COVID bump, or there's a certain trend of Peloton bikes or whatever that causes a spurt in revenue growth that dissipates. Growth tends to revert, back to sort of normal levels. But if you look for companies that have exceptional financial performance and have these ingredients for growth, that they can reinvest in the business and create growth, then they have much more sustainable long-term growth. And they can grow by very significant percentages for much longer than anyone expects. Not a 2 or 3 year growth spurt, but a 10, 15-year long-term growth. So the first thing we start with are margins. So, various types, but, essentially gross margin is telling you about what your moat is. Do you have the pricing power to price your thing, your service, your product appropriately? And does that pricing power show that you have a moat or a non-commodity product? Then, of course, margins flow right into free cash flow. Free cash flow to us captures how much do you have to reinvest in the business to keep the lights on. And we all want a business that we don't need to reinvest in anymore. We don't need to buy any more trucks. We don't need to buy a new machine in the factory. So we love businesses where you have more like a Google and their search enterprise than an automobile company that needs factories before they can get a car out the door. So asset light companies is what those get called. So free cash flow captures a lot of that in terms of how much capital expenditure is required just to replace what is falling apart in your current business. And a great business doesn't need much of that, so they have lots of free cash flow. Then with your free cash flow, you've got options. You can return those to investors as dividends or distributions to yourself. You can go out and acquire companies. We're not huge fans of those two from an investment perspective. Acquisitions have a really mixed record of they basically have net zero benefit to the investor. Some of them work. A lot of them don't. You've got plenty of big failures like AOL, Time Warner. Generally, when we see something rise to the level of what we call a big dumb acquisition, like it's a really significant acquisition, it questions. It's like, do you really have no ideas on how to grow your own business that you need to go out there and buy something? Maybe you're an old business like Time Warner and you're trying to buy into the new economy with AOL. It rarely works out that way. So they're either driven by someone who wants to just manage a larger company, whether that's more profitable or a better company, don't know, but it's bigger, it's more people, it's, gets you on the cover of magazines. So anyways, acquisitions, not a huge fan. Dividends are somewhat similar. This is, maybe a little different between someone who owns their business versus what we're looking to invest in. If a company doesn't have ideas on how to reinvest and their best idea is just to give us our money back in the form of a dividend, Okay, that's fine, but not very exciting. Obviously, not a growth opportunity. So it's the companies that are reinvesting, and those are things like some forms of capex, some forms of marketing. More often, it's R&D, where R&D is a real telltale sign that a company is reinvesting in its future. And then the fourth ingredient is return on invested capital. That's where we get to measure, okay, how good has this company been at reinvesting in the past, right? And so that's where business owners know, hey, if I buy a truck and I put a new crew on it, it's going to take me X dollars to get that going. I'm going to have that paid back in 6 to 12 months. That's like 100% return on invested capital. That's a pretty good number. We see that in public markets as well, where companies have 50, 100, 100 to 50% return on invested capital because they're great at that reinvestment. So that's a sign that the reinvesting that they're doing through R&D actually works.
That's super helpful because, like you said, it's very similar to how we should look at our own small business. Where are we at from a margin standpoint? What's our gross profit? Do we have pricing power? Are we building value in the marketplace, or are we simply competing on price? Are we actually creating free cash flow? I think this is where a lot of business owners get stuck, is they automatically convince themselves, since there is no money, that they are quote unquote reinvesting back into the business. But when we ask them,
Right.
well, what did you actually do to reinvest in the business? They're like, I don't know, but I don't have any profit, so that's what I'm doing. So I think that's a big delineation of like what's actually excess after this given time that we don't need to continue operations. So then we can actually go back to, like you said, reinvesting. What's the return on that invested capital? So some really good
Yeah,
thought
you've had some
processes.
great advice on being clear about, is this really a reinvestment, or am I just spending money in the business because I feel like I should? And yeah, and being
Yeah,
clear
and
on that distinction. And that's some of what we dive into in public companies is, yeah, is this R&D really something that's going to lead to future returns? Is this company, being wise with its reinvestment, and how can we divide that out? That gets into more of the qualitative work.
yeah, and I think the thought process, and I never really thought of it this way, but looking at it at public companies or our own company, is if we are giving out, say, more dividends than most companies, or if we don't have anywhere else to put the money and we're just giving it out. I never thought, sometimes you think, oh, this is cool because the dividend's high and I'm making good money and I can reinvest the dividend, da 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 da. But if we don't have anywhere to put it, that means they're probably not that innovative a company. And a couple of years from now, they might be going the opposite direction. So that's an interesting thought process. So let's simplify this for our listeners out there, because I know you work with us in the home service space every single day. Take a scenario. Our business is finally profitable. We're making excess income. How do you then help our listeners take that excess income to start really building, like you called it, the second engine of growth? Or how do we actually build wealth outside of the value of our business?
Yeah. Yeah. So what we see with a lot of business owners that we work with is they reach a level, often that's high single digits or 10 million in revenue, where now the business is putting off enough profit, enough in distributions, where they need to think of things outside the business. Now that's either because the reinvestment opportunities in the business are less, but I think that's a really interesting conversation to have with CFOs of those businesses of, what do we think the return is on reinvesting in the business? Is it true reinvestment? Or is it time that maybe that return on investment has dropped below 50%? And it's like, well, maybe the opportunity is not so large. It's time to look outside the business. But the biggest trigger is liquidity. And, you talked earlier about, selling to PE. That's really like the only liquid event in a lot of people's viewpoint, right? It's the only way to sort of monetize what you've built. And, I think there's a great book that came out this year called Another Way, which talks about not building for an exit, which is a great book for all the listeners. And in order to do that, you do have to build up liquidity outside the business. A lot of our owners have, 95, 99% of their net worth is tied up in this business, right? So then the question becomes, all right, as you take money out of the business, what are you going to invest in? And for us, it comes back to, it's got to be liquid, because that's one of the reasons you're doing this. And it's got to be a reasonable return. It's got to be a competitive return, because you've got a business that potentially has good returns by reinvesting in it. So it's got to be a good return, and it's got to be liquid. So that rules out a couple things for us. So we have our biases, of course. We focus on public markets, but a lot of people get attracted to real estate. They run a business where they can put their hands on their equipment and they know the guy's doing the work. And real estate's like, yeah, I get it. There's a building there. I buy it. I can touch the building. I know where it is, and rent comes out of it, and it's great. But it's not very liquid. To the extent it is liquid, there's a lot of transaction costs. And so we see a lot of people get a little bit lost in real estate because it's just like a business. It's hard to do the math on what is my actual return here after I bring in all of the expenses, and what risk am I taking with leverage and all that kind of stuff. So it's a very attractive thing, but it's got its complications. And if you look at the unlevered return, it's, mid single digits is what you can expect. Everyone's got their story of the building they bought a couple years ago, but it's doubled in value. No one ever puts the expenses into that equation. And so when you do, often the return is less exciting. So similarly, that might be investing in other businesses. You run into liquidity problems. Sometimes people get big enough that they end up on the private bank folks' radar, and they're pushing them to, now you've sold your business, now you should get into PE and be an investor in PE. Those funds have 15, 17-year lifespans. So public markets for us really hit that sweet spot of they're fully liquid. And we think with the right approach, you can get a very attractive return. You look at the S&P over the last 100 plus years, it's done about 11% per year. That's a pretty reasonable starting point. If you can outperform that by a few percent, even better. But even if you're just looking at that base return, that's, again, competitive with reinvesting in a business. And that liquidity gives you lots of options with what to do with your business.
Yeah, I think the liquidity is, obviously, it better than anybody, but when we have, like you said, 95 to 99% of our net worth tied up into something that not only is not really liquid, but it doesn't actually have that many tangible assets. Like if we're in the
Mm,
trades and we own an HVAC company, our vehicles usually have a note on them. The notes usually equal or actually more than the actual value of the asset. So
yeah.
we're at best baseline with all of our tangible assets there. And even when these businesses sell, they're only selling based on goodwill and this
Yep. Yep.
unguaranteed but guaranteed stream of cash flow that could go away tomorrow. So like when you're able to put it in something a little bit more tangible, a little bit more liquid that we can pull money out of any given time. It's not like we can go to the bank and be like, I want a loan against the value of my business. The bank's going to say, get out of here.
Yeah, yeah. Well, I love that you brought up the tangible aspect, because that goes back to some of my dad's experience with these businesses. When he was running the chimney sweep business, what they were selling, a whole kit to get your business started. They were selling a vacuum, they were selling marketing material, they were selling a top hat because that was part of the branding. It was the Mary Poppins. He talked to some people to get advice. They were in their mid-20s and this thing was taking off, and they're like, "Oh, you don't have anything here. There's no assets to this business." Of course, now, like in our perspective, in the more modern world, it's like, yeah, there was brand equity there. There was all kinds of stuff that had value there, but that's not the advice he got at the time. So that taught him, like, oh, well, I need to go into something with tangible value. And that led to commercial real estate in Manhattan. And that was too much assets, the other side of the coin. So it's a really important point, the tangible assets versus intangible. In public companies, we're always looking for companies where we think there's lots of intangible assets. Because again, it's the tangible assets. Like you can look at a service business and say, oh, that's a bad thing. There's not a lot of assets. But it's important to realize that all those systems that you have in place, all that branding, all that, the flywheel of the marketing, that's all something of real value. And that's what is that intangible value. We're looking for the same thing in public companies. We're looking for things like Google, where all of their code is not a physical asset. They would never sell it. They can't sell it, but it's certainly an asset. And that's what the returns of their business are based on. Visa and MasterCard, they have great brand equity. And that's really important. It doesn't show up on the balance sheet. And it comes back to why, growth value has kind of gone astray. Everyone calls themselves a value investor, but people have kind of gotten lost on that. The value of the Visa brand doesn't show up on the balance sheet. So how does that come into your valuation?
Yeah, it's an
Intangible,
interesting.
tangible is a really fun, geeky, area.
It really, yeah, and it's an interesting conversation. So, kind of tying it all together, if our listeners have 95 to 99% of their net worth tied up in their business and they're creating excess income Dock Street saying, let's go to the public markets. Within that, what are some of the different ways? Because obviously, and we, depending on what you can and can't talk about legally, but like the different strategies within the public markets, whether it's hey K's or hey do a Roth, or what are some of the things that our listeners can take away from this? Be like, okay, that makes sense, and I need to start doing that.
Yeah, we always want to make sure that we're doing things in the most tax advantaged account possible. So often that starts with a 401k. That's a great thing to get set up for a company because it allows owners to put away quite a lot in a tax efficient way. I think the catch is that it's very easy to end up with a high price plan where your investment options in there are expensive and not great performing. So I always think it's very important to have index funds in your 401k plan. And that's not financial advice. I'm not anyone's plan advisor. But index funds meaning passive products that track the S&P and other broad indices that have very, very low fees. That's, I think, a very important option. There's plenty of companies that have gotten sued for not having those in their plan. So I think that's important for everyone to look at. It's a good option for both owners and employees. And then you've got, of course, IRAs. And, when you leave a company, you can roll a 401k into an IRA, or you can always start up your IRA and get started there. I also don't want to underplay the just plain old joint or individual taxable account. People get very focused on avoiding taxes. And one thing we always say is you don't want to let the tax tail wag the dog. Taxes are a very tangible, painful number to pay, but we don't want to end up in a situation where we're giving up returns because it avoids taxes. I was talking to a guy a couple months ago. He was a bond trader. He actually worked in the World Trade Center pre 9/11, and he retired about 20 years ago. And he says, and I've just owned bonds ever since because, the problem with stocks is you buy them and then they go up in value and then you've got to pay taxes on the gains. So for 25 years, he's been making somewhere between 3 and 5%. And he's missed out on almost 15% returns in the S&P. If you do the math on what he gave up on the upside, but that's not a tangible number. The upside is always vaguer, and so we don't want to get too focused on the tax savings. And capital gains at 15% or 20%. It's not that painful to pay, especially if you've made money. So.
Yeah, it's funny. It's interesting how similar the conversation is investing into stocks versus our business as well. Because I talk to people every day say, I don't want to make any money because I don't want to pay taxes. And I tell them,
yeah.
I had this conversation yesterday. I'd rather make $1 million and give 30 to 40% away and have 600,000 left, even with no tax strategy, compared to not making anything and have nothing. Yes, it hurts to write the check to the IRS. Yes, depending on your beliefs, you're not getting any value out of it, But if you have a tax problem, it means you're making a lot of money. Versus if you don't have a tax problem, you're not making any money.
That's right. I always keep in mind our largest client who he's a partner in about 32 different businesses and worth over $1 billion. And his estate plan it's all in a taxable account. The government will take its share and there's plenty left for everyone else. It's all fine.
It's all good. So as we start to wrap up, Spencer, we've talked about a lot of different things, super insightful for me and definitely the listeners out there. We want our listeners to take immediate action. What's one thing they could do within the next 24 hours to start to kind of move forward in this direction of building wealth, investing in the future, creating another engine of growth? What's one thing that you would recommend anybody out there just to start do?
Yeah, I'd say just really adopt or, learn the lesson that the stock market is not a casino. It is a weighing machine that over the long term finds the good companies, and take that excess profit and get involved in the stock market with an index fund to start in whatever account, schwab.com. We use Schwab for 99% of our clients, and just get that started. Start building that liquid reserve so that you have options with your business. You're not forced to sell. If you've got kids and succession planning, that lack of liquidity can really force you into a position you don't want to be in. So start building the liquidity early.
Love it. Spencer Ogden, thanks again for coming on the show, sharing your journey and providing a whole bunch of great advice, insight, and wisdom for all the blue collar business owners out there as we continue on this journey to prosperity. Before we sign off though, Spencer, where can our listeners go to learn more, get in touch with you, learn more about what you guys do at Dock Street?
Yeah, we are at dockstreet.com and happy to chat with anyone.
There you guys go. Go to dockstreet.com, reach out to Spencer. I connect with him on LinkedIn. So if you're on LinkedIn as well, you can find Spencer on LinkedIn. But Spencer, thank you again for coming on the show today. Really appreciate it.
Thank you, Paul.